In the vast and intricate web of global finance, one name frequently emerges as an omnipresent force: BlackRock. It is a firm that, according to its own disclosures and financial reports, manages trillions of dollars in assets, influencing nearly every major public company on Earth. But how did a company that started just over 3 decades ago ascend to such an unparalleled position? This investigation will trace BlackRock's origins, dissect its growth strategy, and examine the unique tools it employs to wield its immense, yet often unseen, power. BlackRock's story began in 1988, founded by Larry Fink and 7 other partners. The initial venture was part of the Blackstone Group, a then-nascent private equity firm. The team, primarily composed of former First Boston professionals, saw an opportunity to provide institutional clients with superior risk management capabilities, a concept not widely prioritized at the time. Their focus was sharply defined: mastering the complexities of fixed income markets, an area often overlooked by more equity-centric firms. The co-founders' expertise was rooted in fixed income investments. This specialization, combined with an innovative approach to risk assessment, quickly set them apart. While other firms focused on maximizing returns, BlackRock's initial value proposition revolved around understanding and mitigating potential losses, a critical need for large institutional portfolios. This rigorous, data-driven methodology laid the groundwork for what would become one of the most powerful analytical engines in finance, demonstrating a forward-thinking approach to capital preservation and growth. By 1994, BlackRock's unique strategy proved so successful that it spun off from the Blackstone Group, establishing itself as an independent entity. This separation marked a crucial step in its evolution, allowing it to pursue its own growth trajectory without the constraints of its former parent. Just 5 years later, in 1999, BlackRock took another monumental leap, going public with an initial public offering that valued the company at approximately $160 million. This IPO provided the capital needed to fuel its ambitious expansion plans. BlackRock's early growth was rapid, driven by its reputation for sophisticated asset management and risk expertise. It wasn't long before the firm's assets under management began to swell dramatically. By 2005, a mere 17 years after its founding and just 6 years after its IPO, BlackRock achieved a significant milestone, announcing that its assets under management had surpassed an astonishing $1 trillion. This achievement positioned it as a major player in the institutional investment landscape, foreshadowing its future dominance. The true catalyst for BlackRock's ascent to global supremacy came in 2009, amidst the turmoil of the global financial crisis. In a landmark deal valued at $13.5 billion, BlackRock acquired Barclays Global Investors, or BGI. This strategic maneuver was not merely an expansion, it was a transformation. BGI was a pioneer in quantitative investing and, crucially, housed the iShares exchange-traded fund platform, a rapidly growing segment of the asset management industry that BlackRock had keenly identified as key to future growth. The acquisition of iShares was a masterstroke. Exchange-traded funds, or ETFs, offer investors diversified exposure to various markets with low fees and high liquidity, quickly gaining popularity. With iShares, BlackRock suddenly commanded a leading position in this burgeoning market. The deal, according to market analysts at the time, instantly doubled BlackRock's assets under management, propelling it from an already significant player to the undisputed largest asset manager globally, with over $3 trillion under its stewardship. The integration of BGI and iShares solidified BlackRock's position at the pinnacle of the asset management industry. Almost overnight, the firm's assets under management soared past the $3 trillion mark. This wasn't just a numerical achievement, it represented a fundamental shift in the global financial power structure. BlackRock now managed more money than many national economies, placing it in an unprecedented position to influence markets, corporations, and even governmental policy through its sheer scale and reach. BlackRock's growth continued unabated, consistently breaking its own records. From $3 trillion post-BGI, its assets under management reached $3.5 trillion by 2011. 5 years later, in 2016, that figure had climbed to $5 trillion. By 2019, it surpassed $7 trillion, and in 2021, BlackRock crossed the monumental threshold of $10 trillion in AUM. While figures fluctuate with market conditions, its AUM consistently hovers between $9 and $10 trillion, illustrating a sustained trajectory of unparalleled expansion. With such vast sums under management, BlackRock holds significant ownership stakes across virtually every major publicly traded company. Reports indicate that BlackRock often owns between 5 to 10% of firms listed on the S&P 500 index. This pervasive ownership means that BlackRock is frequently one of the largest, if not the largest, shareholder in countless corporations worldwide. This extensive reach translates directly into considerable influence over the global corporate landscape, from tech giants to consumer staples. As a major shareholder, BlackRock holds substantial voting power in corporate decisions. This includes the election of board members, approval of executive compensation, and crucial votes on shareholder proposals. This active participation in corporate governance allows BlackRock to influence corporate strategy, environmental, social, and governance (ESG) policies, and even the direction of entire industries. Critics argue that this concentrated power gives BlackRock an outsized voice in how major corporations operate, potentially shifting corporate priorities to align with its own mandates. Central to BlackRock's operational efficiency and influence is a proprietary technological platform known as Aladdin. Standing for Asset, Liability, and Debt and Derivative Investment Network, Aladdin was developed by BlackRock itself and is far more than just internal software. It is a sophisticated risk management and trading system that processes an immense volume of financial data, providing analytics and decision-making support for investment professionals both within and outside BlackRock. Its power lies in its comprehensive overview of financial markets. The true scale of Aladdin's influence extends far beyond BlackRock's internal operations. According to reports, the platform manages assets for over 200 financial institutions globally, collectively overseeing an astonishing $21.6 trillion in assets. This means that a significant portion of the world's invested capital is, in some way, analyzed and guided by BlackRock's Aladdin system. Its client list includes pension funds, insurance companies, banks, and other asset managers, making it an indispensable tool for much of the financial world. While BlackRock touts Aladdin as a tool for transparency and risk mitigation, critics express concerns about its widespread adoption. Some financial journalists and analysts have described Aladdin as a shadow financial system, due to its ubiquitous presence and the opaque nature of its internal workings to outsiders. This raises questions about potential systemic risk. If Aladdin were to fail or miscalculate, the ripple effects could be catastrophic across a significant portion of the global financial infrastructure. The concentration of analytical power is a major point of contention. Beyond sheer financial management, BlackRock, under the leadership of Chairman and CEO Larry Fink, has become a prominent advocate for stakeholder capitalism and ESG investing. Fink's annual letters to CEOs are closely watched, often pushing for corporations to consider environmental, social, and governance factors alongside traditional profit motives. This stance, articulated publicly, asserts that long-term shareholder value is intrinsically linked to a company's commitment to sustainable and responsible business practices. It signals a shift in corporate expectations from a titan of finance. BlackRock's push for ESG has sparked considerable debate. Proponents argue it's a necessary evolution for responsible investing, driving positive change. However, critics suggest that BlackRock, by leveraging its massive voting power, is using investor capital to impose its own ideological agenda on corporations. They question whether these initiatives always align with the fiduciary duty to maximize financial returns for all shareholders, or if they represent an overreach of corporate governance. This tension highlights the delicate balance BlackRock must strike. BlackRock's influence extends beyond the corporate boardroom to the highest levels of government. During times of financial crisis, such as the 2008 meltdown and the COVID-19 pandemic, the Federal Reserve and other central banks have consulted BlackRock on managing distressed assets and implementing recovery programs. While BlackRock holds no direct regulatory authority, its expertise in fixed income and risk management, honed since its founding, positions it as an indispensable advisor, granting it significant indirect influence over economic policy decisions. The accumulated facts about BlackRock's scale, ownership, and technological reach lead to a fundamental question: does BlackRock have too much power? Critics argue that such concentrated economic power, especially in the hands of a single private entity, poses significant risks. Concerns include a lack of competitive alternatives in the asset management space, the potential for market manipulation, even if unintentional, and the sheer volume of influence it wields over corporate decisions, potentially overriding the interests of smaller shareholders or local communities. Beyond market concentration, the intertwining of BlackRock and the global financial system raises specific concerns about systemic risk. A failure of Aladdin, for instance, could have cascading effects, given the trillions it influences. Furthermore, the firm's voting practices on shareholder proposals, despite its public statements, are often opaque to the average investor. Critics also point to potential conflicts of interest, as BlackRock holds stakes in competing companies, questioning how it balances these diverse holdings while acting as a fiduciary. From its origins as a small fixed-income shop in 1988 to its current status as a $10 trillion asset manager, BlackRock's journey is a testament to strategic vision, technological innovation, and aggressive expansion. Its ubiquitous ownership, powerful Aladdin platform, and influential leadership have undeniably reshaped the global financial landscape. Whether BlackRock is an indispensable pillar of stability, a benevolent force for sustainable capitalism, or an unchecked power accumulating dangerous influence, remains a subject of intense debate. What is clear, however, is that understanding BlackRock is crucial to comprehending the mechanics of the modern global economy.